high dividend stocks in Bursa Malaysia for 2024. 2 high dividend stocks away. Build up your passive income to replace your active income. These stable dividend stocks are currently giving 5% or above just for the dividend returns every year. Kicking things off, we have a Rexit Bhd. At the current price, dividend yield for the past 12 months at a respectable 5%. Rexit, which made its debut in 2005, focuses on delivering solutions and services to general insurance and Takaful industry. The group offers several web-based insurance solutions that cater for front-end marketing and sales functions, as well as back-end operation and management requirements for insurance companies. And do you know that Rexit is also the company that makes EPFI Invest system possible? For the past 1 year, its stock price had been silently uptrending from 70 cents to 90 cents range before spiking up due to positive takeover news. Now, how likely is this dividend payout can be sustained or even go higher in the future? For this, we look at its net margin. They are in the impressive range of 36 to 42%. Between the financial year ended June 30th, 2020 and 2023, Rexit profit climbed steadily from about 9.5 million to about 11 million. Disclaimer, this is not an investment advice. This is also not a recommendation to buy the dividend stocks cover, as I do not know your financial needs, circumstances, risk appetite or investment objectives. Then next, we want to look at these stocks dividend risk to you. For this, we look at a company's leverage and shows the extent to which operations are funded by lenders versus shareholders. Now, in the business world, a gearing ratio refers to a company's financial leverage. Essentially, how much debt they use to run their operations. Debt can help a business grow faster, just like in racing. Higher gears lead to greater speed, but too much debt can cause problems. If the interest rates rise unexpectedly, heavily geared companies can go bust overnight. Gearing is total debt minus cash divided by shareholders' funds. For Rexit Bhd, it does not believe in external borrowings to expand its business. It uses its own money to sustain and grow. Next, Petra Energy Holdings. At the current price, dividend yield for the past 12 months stands close to 11%. Now, take away the special dividend, you still have over 6% dividend yield. Petra Energy Holdings is one of those boring companies that would never make any news headlines. Does this sound remotely exciting to you? Integrated brownfield services for upstream oil and gas industry. It also supplies specialist products and services for the petrochemical industry. For the past 1 year, its stock price had been range bounding between 80 to 90 cents per share. So, how likely is this high dividend payout can be sustained or even go higher? For that, we look at the percentage net margin for the past few years. It has always been razor thin at 3 to 5% only. Growth-wise, not very convincing at all for the recent years. The consolation for this is that Petra Energy gearing ratio is kept super low to below 10%. Its net cash position might be the reason why its growth is nothing to shout about. But hey, just like Rexit, its management probably do not believe in external borrowings to expand its business. Instead, it prefers to use its own money to sustain and grow. Of course, this may improve or worsen in the future. So, if you want to be aware of future changes, do follow and subscribe. If you prefer weekly email update, there's a link in the description below or in bio. Questions, ask below. Here's your next high dividend stocks clip to watch. There's an entire series of this. Also check out more of these global investment strategy videos updated monthly only for CF Liu channel insider members.